We're here to talk about the Silicon Valley real estate market. We will talk about Santa Clara, Alameda, and San Mateo counties. After we finish that up in about 40 minutes, we will spend about 7 minutes talking about the Greater Bay Area, which is 13 counties and 5 regions. These are the key chapters we're going over. This is sort of what the graphics look in each one of the chapters. You can jump to the portion that you like the most or watch the entire thing. I'm Richard Calhoun, Creekside Realty, real estate broker working with buyers or sellers here in Silicon Valley. My contact information is on the bottom of each slide or on chapter 12, and that tells you how to get the handouts as well as how to participate live on Saturday mornings at 9 a.m. Let's get into the first data slide. This is sort of a summary slide. The fourth component is the one that's going to be the most interesting, but inventory you can see is very close to the red line, which is the least inventory you'd expect for this time of the year. We're only at 80% of the previous 10 years. So I don't count the current year. I go back 10 years, which was 2014 through 2023. That I take the median of that, and we're only at 80% of that inventory for this time of the year. My real estate year starts on March 1st, goes forward 1 week at a time until you wrap around until February 21st. Then instead of jumping forward a week, I jump forward 8 days on a normal year, 9 days on a leap year to get back to my starting date on March 1st. Then you jump down and look at offers accepted. Offers accepted started below the least you'd expect. We improved a little bit, and now we're back down close to the blue line, which is the least number of offers you'd expect. Blue always favors the buyer. Red always favors the seller. We're at 79% of the offers that you would expect to be accepted for this time of the year. Moving on to days unsold inventory. Days unsold inventory is the theoretical speed at which the market would be sell all their existing inventory at the existing rate of sales. It's the supply demand balance or the seller buyer balance. You can see that we started off the quarter at 46 days, which was 3% higher than it normally is, 3% slower marketplace than it is now. Now it's down to 32 days, and that's 7%, 8% faster than it normally is. The reason the market typically improves at this time of the year is simply because the sellers tend to disappear at a greater rate than the buyers as we approach the holidays. Buyers tend to be less impacted by holidays than sellers. And this is the length of time it's taking 75% of the sellers to sell their property. It was 6% longer than normal at the beginning part of the quarter, and this is a moving quarter the past 14 weeks. And now it's 32% longer than normal. We've gone from 26 days, which is less than 4 weeks, all the way up to 47 days. It's almost a doubling of time. And we'll see this on a chart later on as well, where the marketing time, the actual time it takes for 3/4 of the sellers that do sell to sell is actually almost at an all-time high, which may say, what the heck's going on? But I'm not too alarmed by it. It's something to pay attention to, and I think I have a reasonable explanation. And part of that explanation is down here on ask price reductions. Normally, we were taking, well, basically a 1% price reduction on average. And the reason that number is so small is the vast majority of the sellers, somewhere around 15 to 25% of the sellers, are the only sellers that are doing price reductions. Sometimes it's less than 15%. So call it 1 in 5 sellers does a price reduction. That means 4 out of 5 sellers are doing no price reduction at all. That's why this number is so small. That's actually 15% greater price reductions than normal, which is why you can see that you're on the blue side of the gray line. Fast forward to current day, we're now taking a 1.3% price reduction. So, basically a third more of a price reduction than we were at the beginning of the quarter. And that's 32% more of a price reduction than we typically take. What's happening is sellers are taking more price reductions. In order for a seller to take a price reduction, they've been on the market for a while, but when the seller takes a 10 or 12% price reduction, that reinvigorates the buyers who now come out and purchase that reduced property and may even overbid that now reduced asking price. And that causes the days on market of the properties that are accepted to skyrocket. And that's what we're seeing in the last 3-4 weeks here, is we went from basically normal to now significantly more higher than normal, longer marketing times. And the last summary slide is overbidding. And this is on here more as a curiosity. It's something that consumers seem to be the most interested in. And we started off overbidding 5.7% over the seller's ask price, a full percentage point higher than we typically are for that time of the year. And now we're still at 5.1%, so we've come down 0.5%. But normally the overbidding is down to 3.8%. So the amount of overbidding has become a little bit greater than normal in relationship to normal. So the vertical separation from the gray line up is a little bit greater over here on the right-hand side of the graph than it was 14 weeks ago on the left-hand side. Here now is a long-term look at the data. You're going all the way back to January 1st, 2014, the first 9 years up to January 1st, 2023. So through 2022, those 9 years are what I call on the condensed scale. Then I expand the scale so you can see what an annual cycle typically looks like. And the 1 year may not be the typical cycle, but if I kept it condensed, you wouldn't be able to see current shifts. And then the current year, which is almost over on the far right of the graph. You have 3 slides. You have the purple, which is inventory percent of normal. So you can see that you're basically at 80% of the normal inventory. Hiding right behind the inventory is the orange line, the number of offers. And you can see that the orange line is a little bit lower on the right-hand side of the graph than the purple line, which indicates it's a tad lower than that 80%. And I forgot what the numbers were. Maybe they were 79.9% and 79.5% or something like that, but they're both very close to 80%. But the offers is a little bit lower than the active inventory. Then the gray line is the ratio between the two, and you would expect that to be slightly over 100%. But as it turns out, all 3 of these metrics, the median for the past 10 years occurs in different years, so there isn't the direct one-to-one correspondence that you'd expect. So looking at just days of unsold inventory compared to days of unsold inventory for the past 10 years, it's sitting at 92%, an 8% faster marketplace. The marketplace is turning over more rapidly, but yet the time on the marketplace is climbing fairly hard, which would almost be contradictory. Here's your inventory. So now you're starting to see the annual pattern of inventory. The gray line is the 10-year median, so that's where you'd expect the inventory to be. The blue is the most, or the inventory level that favors the buyers the most. Red is the inventory level that favors the seller the most. And you can see we're basically right on top of the red line. We're clearly, and it's the vertical separation, not the horizontal, that's important. We're clearly below the gray line and basically right on top. So we're basically having very limited inventory. Yes, you can have inventory lower than you would expect. I do the expectations either both on the low side and the high side by the 10 and 90 percentile. So you can have the 5 percentile and the 95th percentile. We're basically right on the 10 percentile for the previous 10 years. Basically not much for a buyer to pick and choose from. Here is now taking that gray line and stretching it out and saying, what is the ratio of the current data to that normal? And you can see we're down at 80%. When you look at this, you can see since the pandemic, we have spent a lot of time down here somewhere around 70% with huge swings, all the way up to 100%, all the way down to 60%. Our worst time down here was right when the market was super heated, where we only had 40% of the inventory that we would expect. So we have double that inventory, but you're 20% less than you would expect. So clearly a shortage of inventory. And you can see there's been basically a shortage of inventory ever since the pandemic. Prior to the pandemic here in 2020, you had mostly a surplus of inventory. Things have definitely changed around. Here's looking at the offers accepted, and you can see offers accepted for the last 2 years has been very low. Right after the pandemic, we had significantly more offers. You were above the red line here. You had the shelter in place that really slowed down the market because you weren't supposed to be even showing properties, let alone selling properties. Then we had the huge run up where right after the pandemic, by June 1st, we were selling more inventory than you would expect, selling more of it. And we stayed that way through the early part of 2022. I maintain that the market probably changed on about Valentine's Day of 2022. And then, since the market changed, we've had significantly less offers than you would expect. And you can see you're basically at or below the blue line for most of the time. Right now, you're slightly above the blue line. So the market has recovered a little bit of the volume, but still significantly below, vertically below the gray line, which would be up here somewhere around 1,750 or maybe even 1,800 is probably stretching it. But we're significantly below where you'd expect it to be because we're down here now at 1,400 on the right-hand side of the market. Okay, so we talked about the number of offers. Let's move on to the next slide. Now we're looking at the number of offers compared to normal. So again, I took that gray line that was curvy and straightened it out and just where are we compared to normal. And you can see we're down here at 80%. When you look at it this way, you can see that we spent most of 2023 at somewhere around 70% of normal. And this year has been up and down and all over the place. But I think there's a trend line somewhere right through here where we've been growing, and we've gone from 70% of the offers accepted up to 80%. And that's sort of interesting because we're no longer the worst out of the previous 25 years, and we'll see that in a table coming up in a while. But nationally, apparently, they're still, basically, I heard the other day a record low. We're up from a year ago, but we're, which doesn't make a lot of sense, but they're still saying that we're the lowest number of transactions since 1999 or some year back there. And, California market just does not follow the national average, just like I believe firmly the Bay Area doesn't reflect what's happening in a given marketplace. So you got to be real careful. I believe real estate's a very local event. Now you're looking at days unsold inventory. That's the ratio between the two. Now you can see that your days unsold inventory is down at 30. So it's a little bit faster because you'd expect to be up here on that gray line that's right there, somewhere around 32, 33 days. So you're basically about 10% faster than you typically would expect for this time of the year because the gray line is that 10-year median, the 10 years being 14 through 23. And here's pulling out the gray line, making it straight. Here you can see you had the huge speed up of the marketplace, the very rapid pace of the marketplace after the pandemic. And then, so here's this huge slowdown starting somewhere around February 15th, 14th, huge slowdown in the marketplace, then a gradual improvement, and then bouncing around. Then we had a slowdown. And I don't have any explanation for the slowdown. A lot of people have said it was the change in the brokerage structure, which to me in California was a non-event, but it still seemed to impacted the marketplace second and very early part of third quarter, second part of third quarter, and fourth quarter. The markets improved and returned to normal. What caused that slowdown over this summer, basically second quarter into third quarter? So you're basically talking April 1st, which was after the jury verdict was out, through about 4 months, so somewhere around August 17th, which is right when the new rules went into effect. People found out it was a non-event, and then they came back to the marketplace. I don't know. To me, that should never have impacted the marketplace. Here's the marketing time. Look how this purple line in just the last few weeks has gone straight up. It's blown through the blue line, the least you'd expect. It's now up here. And if you go back and look, this is almost the highest level. Yes, there are times when it's higher, but the peak is typically early in first quarter. We'll take 2023, early and midway through first quarter, so right around February 15th. Then you come back here to 2020, before the pandemic, right middle of January. Come back here to 2019, middle of January. Come back here to 2017, middle of January. Come back here to 2016, late in January, maybe early February. Here in 2015, mid-February. 2014, mid-February. So now you're almost at the same height as those previous peaks. But if you look at the trend, I would expect this trend to continue to climb through at least the first week in January. And if that continues, there's a very good chance that the time to sell 3/4 of the market will be longer than ever. In other words, I'm almost looking at the steepness of the slope. I'm saying that we could set a new record slow in the marketplace. And that would just not make sense with the DUI being low. How can I reconcile those two numbers? Basically, what I think is happening is sellers are having to reduce their price, attracting the buyers. The buyers now buy that property that's had a long marketing time, and that's causing the days on market to climb like we're seeing. So it's been a fairly recent event because here you can see well into fourth quarter, about halfway through fourth quarter, we were absolutely normal. So this is right around Thanksgiving. And then boom, ever since Thanksgiving, we've been just really climbing. So the market has changed since Thanksgiving, which would be a market falling apart. But almost every other indicator that I have noticed is indicating the market's absolutely on fire. So I think it's the sellers reducing their price, and we'll start seeing that coming up in a little bit. And here you can see, pulling out the gray line, you can see the percent, we're 32% more than normal. You can see that there's been times when it's been higher, but sort of the minority. We're getting up in the longer marketing times for Silicon Valley. Now, here's starting to be some of the supporting documentation. Here's where the price reduction should be, is on this gray line at around 88%, and now it's down around 86%. And this is the sellers that are taking the largest price reductions. So the sellers that are reducing their price are taking 2% larger price reductions than they normally do. That may not sound like a lot, but when it's only normally 12%, that's 6% more. That's 1/6 more price reductions, about 17% more of a price reduction than they normally are taking. And I think that's what's bringing back the buyers. Now we're going to look at that compared to normal. You can see that we've been somewhere around 115% of normal. Now you're at 120%, 122% of normal, actually approaching 125% of normal. Now we're looking at the average. So now we're adding in all those zeros, and you're having the same trend. Normally at this time of the year, the price reductions are actually decreasing. This year, they've been increasing again since about Thanksgiving, first catching up to where they typically should be, crossing over now, and now the average is about 1.3% price reduction. Again, that sounds like a small number, but that's because the vast majority, somewhere north of 80% of the sellers, are doing no price reduction whatsoever. Here you can see again, here's where the typical line would be on the gray line. You can see the amount of deterioration in the last couple weeks. And so the amount of price reductions are really increasing. Here's the frequency. Now the frequency is almost normal, and it's right at 20.5% of the sellers are doing price reductions. So 80% of the sellers are doing no price reduction, but the 20% that are taking significantly larger price reductions than they have been. And that must be causing those buyers now to buy those properties with large marketing times. Now here's compared to typical. You can see we've got much lower than normal frequency. Now we've gone back up to normal, and now we're about 10% larger frequency than normal. So instead of it being 18%, now it's 20% of the sellers are doing price reductions. Here's overbidding. So even though we've just been talking a little bit about slow stuff, the overbidding is at 2%, and typically it's down here at somewhere around 1%. So you have almost double the overbidding. And this is the median overbidding. The number I showed earlier, that 5% is the average. Average overbidding is always going to be higher than the median. Median, again, is the midpoint, just like on price. Median's list price, median sold price is always going to be lower than the average list price or sold price. Here's your overbidding compared to normal. So you can see we were increasing. We actually decreased a little bit, but you have a 1.5% larger overbid than normal. So if the overbid is normally at 1%, it's now at 2.5%, 1.5% higher than normal. Here's the frequency of overbidding. So I had a client try to tell me that his lender was saying that there's no overbidding going on. Well, in all of Silicon Valley, it's 60%. And in the micro market area that they were looking in, 100% of the offers that were accepted in the past 5 weeks had been overbidding. With the factual data, I was able to see that his mortgage agent was just babbling and not looking at actual factual data. Here's the frequency compared to normal. So you have a little bit higher overbid than normal. That'd be about 4% more overbidding than typical. Here's the long-term sale price. Look at the downturn in the last couple of weeks here. So we've had a significant reduction, which is the V that we normally have at every year. So we had this upside down U, and unusually we came below the blue line over the summer. Then we started following the blue line, and now we're having the end of the year V. So real good time for a buyer to be purchasing if they're not picky, because you can't be picky when there's no inventory because there's not much to choose from. Notice that every year this turns around very early in January. So I expect this to come down and turn around. And also keep in mind, there's a 5-week roughly lag time on this, especially when the market is slow. This turnaround in mid-January is actually a turnaround that's already happened in mid-December. So we just don't have the data to reflect that yet. Here's your prices. This is the cheapest 10 percentile here in Silicon Valley. Here's your median, and these are mortgage payments using the federal national average for a 30-year fixed mortgage. And then here would be the most expensive at almost $26,000. And I do include an estimate for property taxes and insurance. So this would be the person's total payment, assuming an 80% loan. Now we're doing something that's fairly unique. I'm not aware of anyone else doing this. I'm looking at the weekly distribution. The purple line is the current distribution. Notice how close we're getting to the blue line on the side here with the longer marketing time. And that's what's happening is this end up here is going up quite a bit, raising the 75th percentile. So this number's getting inflated up. But again, you can see that, half your market's behaving pretty normally. And that's because half the market is priced aggressively. It basically comes on in the market and sells. So it's the 50% of the markets that's taking the longest. But each line on here is a weekly distribution. I start off on the blue line a year ago. So you can see the first 50% was exactly where we were a year ago. But the top 50%, the slow 50%, is significantly slower than we were a year ago. And that's what, and the 75th percentile again is right here. So this is what the 75th percentile is reporting on, right? That data point there. And I jump forward either 4 or 5 weeks, trying to keep the middle number, the day of the month, roughly the same. But I believe firmly that you need to look at weekly data in real estate. It's too driven by the open house and sellers coming on the market around open houses, buyers finding houses on the open houses, and then offers being accepted the following week. We don't look at a monthly cycle. There was a monthly cycle when interest rates were 19% and 18% and very high because a buyer wanted to close at the end of the month to keep his prepaid interest low. And that was actually a common phenomenon. With the lower interest rates, even at 6%, that's just not an issue. And the market is hot enough that the buyer really is not in control. They can try to get a longer escrow, but that's a tough sell. So we're starting off a year ago on the blue line. Then we'll jump forward roughly 4 or 5 weeks. That was the slowest of the market. We're coming up on the peak of the market right there. And then you're going to start slowing down. And now you're going into the summer. And basically from that point on, there really isn't much change. You can see just a little fluctuation. You're actually improving. Now you're slowing down a little bit. So basically the summer stays the same. And now you're starting to slow down. Right, see the jump? See the jump? You're jumping up each time, week to week to week. And now that's the current line. And so the real takeaway is it's 50% of the marketplace here is what's really slowing down. So if you're buying the stuff as it comes on the marketplace, as most people do, you're not going to notice any change at all. And that's one of the reasons I watch this number. It's how long it's taking the longer group to sell that's really increasing and getting close to the record. This is the record up here as far as I'm aware, and it was basically fairly recent. So I'm not positive that I went all the way back to 2014, but we're getting close to the worst data that I have plotted, but we're not quite there yet. Now we're doing the same thing on price reductions. So here is where we were on the blue line a year ago. The purple line is the current year. You can see across the board, the price reductions are greater than they are. They're nowhere close to the worst we had, which was again, December 27, 2022. So simply 2 years ago, you were way down here. And now you're fairly close to where you were last year, which was the blue line. But the purple line is larger price reductions than we were a year ago. We'll step through and watch the change. Now you're racing up. There's the peak of the marketplace in the spring. Now you're quickly coming down to the summer. Now, basically, there's really not much change. So from 5 months ago to, not quite to present, to about a month ago, there wasn't much of a change. And we'll see we're clearly in the weekly data now. So 7 weeks ago, 6 weeks ago, 5 weeks ago, really no. Now we're starting to see it 4 weeks ago. See the marching down? And there's not much change from last week to this week. But again, there are larger price reductions than there were last year because we're down towards the blue line, but we're nowhere where we were 2 years ago back here on Christmas time of 2022. And now finally the overbidding. And here is a reverse. Now this data again is lagging behind because you need the closed data. But a year ago you were down here, which is a cooler marketplace, than up here. So even though the previous two distributions would indicate the market's slower this year than it was last year, what the buyers are actually feeling, the competitiveness, is saying that it's more competitive, and so they're overbidding a larger amount on the purple line versus the blue. But we're starting off on the blue line a year ago. There's the least overbidding. Now you're rapidly coming up. There's the most overbidding. Now you're rapidly slowing down. And now there's really no change from basically 5 months ago to almost present day. Well, actually, all the way to present day, there's no change. It's just bouncing. So we have a very cyclical market that's impacted dramatically by these end of the year holidays, where we slow down going into them, we catch on fire, and then we overshoot the marketplace, and then we come back to where the market should have been. Now what we're doing is going back and looking at the three counties: San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. And you're looking at all the way back to 2014. You can see that Alameda County and Santa Clara County are fairly close together for most of the years. And right now, Alameda County has 50% more inventory than Santa Clara. So that's quite a bit more inventory compared to historically. So Santa Clara County has less inventory than Alameda County. San Mateo County is doing roughly normally for itself. It's a smaller county. Offers accepted, same thing. San Mateo County is roughly, it appears, just rough numbers looking back, reasonable numbers. But Santa Clara and Alameda County are significantly lower than where they typically are. And it's interesting, Santa Clara has almost as many offers accepted as Alameda, even though Santa Clara had less inventory. So the Santa Clara marketplace is turning over much more rapidly than the Alameda County marketplace. And here you're seeing the turnover rate. Santa Clara County is the fastest with a DUI of just about 24, 23 and a half. Then San Mateo is next at 32. And then you have Alameda County coming in the slowest at about 36. Here's marketing time. So even though the marketing time has skyrocketed, for Santa Clara County, it's still reasonable because it's somewhere around 36 days to sell 3/4 of your properties. San Mateo County is about 49, and Alameda County is about 53. So those are getting to be fairly long marketing times, but still, to sell 3/4 of your property in under 2 months, that might not be, that would probably be a fast pace for most of the country. It's relatively slow for the Silicon Valley area. Here's the magnitude of list price reductions. So Alameda County is doing the most price reductions, followed by San Mateo County, and Santa Clara County is doing the least amount of price reductions at only 0.9% on average. So that includes the ones that do no adjustment at all. Now looking at the frequency, Alameda County is approaching 25% at 24% of the sellers doing price reduction. San Mateo County is next at about 21.5%. And then Santa Clara is way down here at only 16.5% of the sellers are doing a price reduction. Here's the overbidding. Alameda County is sort of weird. Even though it was the slowest marketplace, it's got the most overbidding at almost 6%. It's 5.75% overbidding. Santa Clara and San Mateo County are basically identical. I can't see exactly where San Mateo County is on this slide. I think it's very, very close to Santa Clara's, and that's why it's not popping out. So they're both somewhere around 4.5% overbids. Here's the frequency of overbidding. Santa Clara County now is the slowest, the least amount of overbidding, which is an unusual position for Santa Clara County to be in. But right now it's got the least amount of overbidding at somewhere around 57.5%, maybe 57% overbids. San Mateo County at a full 60, and Alameda County at about 62% overbidding. This is the appreciation. Santa Clara County has had the most appreciation, it's somewhere around 95% appreciation since the last 9 months of 2015. San Mateo County has had the least, and then Alameda County is close to San Mateo County. You can see that they were much closer together than before the pandemic. Subsequent to the pandemic, San Mateo County has been doing the least well. You'd almost expect Alameda County to be doing the best based on the affordability and longer commutes, but clearly Santa Clara County has had the highest appreciation or benefited the most from the pandemic. Here's the long-term pricing. Notice these huge decrease, especially in San Mateo County. There's a $200,000 price reduction, a 10% price reduction in the median for a county in just 1 week. I did not have the time to go back and verify my data, but I have no reason to believe that's inaccurate. So that says in the last week, we sold a whole bunch of inexpensive homes compared to what we sold 6 weeks earlier. You can see Santa Clara County is coming down, but nowhere near as steep as San Mateo County. But Santa Clara County started earlier, but still, even the price reduction, this number is lower at maybe 1975, and now it's higher at 1825. So Santa Clara County is actually more expensive right now than San Mateo. Yes, that's happened a couple times here, but it is fairly rare still, but it is currently happening again. And Alameda County also went down a little bit. Here's the same number on regular paper for those that prefer, and you can really start seeing the huge vertical drop in price in San Mateo County. Santa Clara County has been coming down at an angle, and Alameda County down here in the gray is sort of in between the two. I put in the horizontal line, and I don't want to go through the data point because that sort of hits it, so it's sort of aimed at the data point. But then you can come back and see that San Mateo County is now below their 2023 pricing. Santa Clara County is still above, and Alameda County is below their 2023 pricing. Here's the estimated payments based on those sell prices, and that's using the same formula, 80% loan at the federal national average. Here we get into micro markets. This is where I think the market is really key. And you can just quickly look at this map and see there's a huge lack of inventory, especially in the heart of Silicon Valley. And Foster City is a very small area, so you ignore that. Basically, white in color is a normal marketplace. Red in color is favoring the seller, which means lack of inventory. Blue, when it does occur, is lots of inventory favoring the buyer. Here's the same thing on the number of offers. You can see Saratoga Las Gatos actually is the only pink that I'm seeing on the graph. You can see most of these are blue, which is indicating a lack of offers that accepted. I also have the Silicon Valley data that doesn't get plotted, and the Santa Clara, each of the three counties are above there, and then the markets are numbered in the same teen underneath. So 10 through 17 is Santa Clara, 20 through 26 is San Mateo, 30 through 37 is Alameda counties. Here's the DUI where the market's turning over the most. So you can see that your affordable areas in Santa Clara County, as well as one of your expensive areas, have the highest turnover rates. The slower areas are your more affordable areas, which is sort of interesting right now. In Redwood City, more affordable in San Mateo County, the Central South and East San Jose, as well as South County in Santa Clara, are also having the slowest turnover rate. And that's compared to normal. Now you're just looking at the turnover rate, and you can see that even though it's a balanced marketplace, the affordable areas in Santa Clara County are the slowest areas in Santa Clara County. Same with Redwood City. You can also sort of see Hayward in Alameda County being the same boat, as well as Oakland right up here. This is my representation of Berkeley and the island of Alameda. Berkeley, of course, is off the top of the map. Here's your marketing time. This is looking only those longer sellers, the 75th percentile. You can see it's really slow in the San Mateo County coast, slow in South County, in the expensive areas in Santa Clara County, as well as, I guess that would be Oakland up here. Here's now looking at the ask price adjustments. So the least amount of adjustments are in Fremont and also in the Bay Cities area of San Mateo County. The area that's doing the most price reduction is the coast. They're doing a 7.5% price reduction. I think that's the most I've ever seen. That's just huge, because most sellers do their homework and put their home on the market at the price they're expecting to sell. So for the average to be 7.5%, I mean, that's almost hard for me to understand. Here's the adjustments. You can see on the coast, 61%, approaching 2/3 of the sellers are doing price reductions, which explains why the magnitude is so high. You can see a lot of people doing price reductions down here in South County, as well as Oakland. Very few price reductions in the island of Alameda and Berkeley. Actually, the number is only 6%. It's only 6 out of 100 sellers are doing a price reduction, less than 1 out of 10. Here's the overbidding where the buyers feel the most pressure. Still large amount of overbidding, but clearly nowhere near the saturated red of 17%. You can look at these numbers, 9% are some of the highest overbiddings that I'm picking up. The absolute highest is Berkeley and Alameda at 12% overbidding. Frequency of overbidding, again, you can see the Pleasanton has very little overbidding at less than 30%, so less than a third, less than 1 in 3 sellers is getting an overbid. But then you go to Foster City and 100% of the sellers are getting an overbid. In Milpitas, the overall Milpitas, Berryessa, Blossom Valley, Santa Teresa, it's 62% of the sellers are getting overbid. This is long-term appreciation. Basically, the more affordable, a little bit longer commutes are the areas that have done the best since the pandemic. Livermore, I believe, and I should check that, I should verify my belief, used to be red in color. I think what's happening is people that went out to the Livermore area immediately after the pandemic are now being somewhat forced back to work, and they're trying to come back into the area here that's now on fire. You can see the close-in places are the more ones that have appreciated the least well, and most of that's been since the pandemic. Here's the sold price, and instead of following the median, which is the middle number, I follow the 10 percentile, the cheapest 10 percentile, as well as the 90 percentile. So you're sandwiched in each one of the areas. So you can see your red here is the most expensive areas, and then your blue down here in Oakland are the most affordable, and you can get a range. That helps buyers narrow down the different micro market areas that they should be considering looking for based on their affordability. Here's a summary. You can start off on the left-hand side in the geographical micro market area, or start over on the right-hand side with either your payment or your affordability from a lender. And then you read across and see what kind of market conditions you have. The highlighted yellow are the sort of leading indicators. Your highlighted orange are your lagging indicators because you need the sold price. Here's the actual data count for all of Silicon Valley, Santa Clara, San Mateo, or Alameda counties. Notice the huge drop in the number of new listings. I'm dropping off 20% and getting 20%, and when you're losing 16%, that means you picked up almost no new listings this week, because 80% of my data is the same. Number of active listings can drop more because of offers, and they are dropping by 20%. So it's just a huge swing, and this happens every year. The marketing time is decreasing, that measured on days unsold inventory, which is an acceleration of the marketing time. And then you have the median days on marketplace that the typical buyer and seller are feeling, which are very reasonable numbers. And then the average, and then actually the 75th percentile, which is what I think is sort of an interesting benchmark. Then you get down into the overbidding and appreciation. And actually here you can see the difference in the appreciation since 2015 since 2020. So Santa Clara County has gone up 35% since the pandemic. San Mateo County has only gone up 13%, and Alameda County has gone up 21%. So you're really seeing the difference down there. Here's the number of offers that accepted. Noteworthy here, we went from the 4th slowest year to the 3rd slowest year. 2007 now has more transactions than 1385, and this number will continue to go down as transactions fail. So 2022 was the worst year at 1195. 2022 was the 2nd worst year. 2024 was the 3rd worst year, and way back off the table in 2007 was the 4th worst year. We've been talking about the Silicon Valley real estate market. We will be getting into the Greater Bay Area real estate market. 13 counties, 5 regions. The blue YouTube archive here is all the old videos on archive. You can also type in the shorter green root URL. You can use that green root URL, adding 2024, soon to be 2025, to get to the live presentation Saturday morning at 9 a.m. If it asks for your passcode, here it is. To get to the handout, you type in the green root URL, the letter H for handout, 2024, and then the month and date code. Again, it will be the 2025 month and date code once we roll over into the next year. If you want any specific episode, it's the green root URL plus the year, month, date of the Saturday presentation. I'm Richard Calhoun, broker with Creekside Realty. My contact information is here for you. I represent either buyers or sellers in Silicon Valley real estate transactions. If you have not already subscribed, I'd appreciate a subscription. and appreciate a like on each and every video you watch. Moving on to the Greater Bay Area. This is the 5 regions we're going to be covering. Silicon Valley is the one we've already gone over. We will only be going over them in comparison. San Francisco and Marin is the cities. North Bay is Sonoma and Napa, Solano, and Contra Costa County. Central Valley is San Joaquin and Sacramento, and the Central Coast is Santa Cruz and Monterey. Here you can see the inventory is going down in all 5 regions. This is typically what it does, as you can see over the past years. The end of the year holidays really does impact the real estate marketplace. Here's the number of offers that accepted going down in every area except for the Central Valley, where it's actually going up, and it's sort of unusual. I am not aware of any other time at the end of the year where number of offers has gone up for several weeks in a row like that. If you look at North Bay, it's basically flat. You could argue it's gone up a little bit, but I would say that's flat, where Central Valley has actually increased from something like 1,200 to 1,400 transactions over the past 5 weeks. So it's really hard to be increasing your number of offers at this time of the year. And Central Coast looks like it's exactly flat from last week. Here's the speed of the marketplace. You can see because of the Central Valley's increasing offers, their speed of the marketplace, their turnover as measured by days on sold inventory, has been plummeting. That's an improving marketplace. You can see it's going down in all 5 regions. It typically goes down at the end of the year because sellers disappear to a greater degree than buyers disappear. Here is the marketing time. Look at the marketing time basically going up in all the regions. You could argue that Santa Cruz and Monterey is basically flat. It went down, it came back up, and now it's leveled. And even North Bay looks like this last week is basically level, but the longer term trend for all the region is increasing marketing time. So it's taking longer to sell the properties. I think what's really happening is with less inventory and buyers not disappearing as a greater rate as sellers, the buyers are going back and settling for properties that have been on the market for a while. And also sellers have been doing greater amounts of price reductions, which makes their property attractive, and they have long marketing times on them. And that's increasing the 75 percentile marketing days. Here's the price reductions. So you can see the San Francisco, the cities, has had a huge increase in price reductions. The average went from basically just over 99%, maybe 99.2%, all the way down to 97%. So that's a huge increase. And all the regions are increasing at differing levels, but large increase in price reductions. This is the frequency of price reductions. Basically, they're almost flat. They're up in Silicon Valley. They're way up in the cities. The other 3 are relatively flat and fairly stable. So for the most part, except for in the cities in Silicon Valley, the frequency, the number of sellers doing price reductions really hasn't changed, but it has changed significantly in the cities and somewhat significantly in Silicon Valley. And when I say that, it's gone from 15% to 20%. So that's a 5% increase, which may not sound like a lot, but it's a 33% increase on the 15%. So it all depends on how you do your comparison. Here's the magnitude of overbidding. So this is the pressure that buyers are feeling. The cities has the most overbidding, followed by Silicon Valley. Both fairly similar, between 5 and 6% overbidding. Then you jump all the way down in North Bay, it's about 1/4%. Then you jump down to the Central Valley, which even though the number of sales is increasing, the price reduction is almost a 0.5% price decrease when you go in with the offer. And then the Central Coast is a full percent price reduction, which means they're only offering 99% of the seller's ask price on average. Here's the frequency of overbidding. The most overbidding is in Silicon Valley at 60%, followed by the cities at somewhere around 55%, then North Bay at 40%, Central Valley at 34.25%, and then Central Coast at about 33.5%. Here's the long-term appreciation. The cities have by far the least amount of appreciation. And then you have North Bay is next. Then you have the Silicon Valley and Santa Cruz, Monterey right together at about 80% appreciation. And the area that has the most appreciation is that Central Valley area. Here's the median sold price. You can see that the cities in Silicon Valley are right together at about 1,550,000. Then you jump all the way down to 1,100 for Central Coast, then all the way down to North Bay at 800,000, and the Central Valley at 550,000. And Central Valley looks way more stable in pricing than the cities and Silicon Valley. Look how much of movement these two have versus Central Valley, which is almost a straight line. Here's the monthly payments for the same programs. They're all going through the same formula. This includes an estimate for property tax and homeowners insurance. And it's assuming an 80% 30-year fixed at the national federal rate. Here's the actual raw numbers, the different metrics across the top, the different areas down the side. Not only do I have the 13 counties, I have Silicon Valley, I also have the Bay Area. I think the Bay Area is a real garbage number, but I include it only because the media focuses on it so much. And the reason I think it's a garbage number is it's irrelevant. You know, if you look at like median days on market, 25 for the Bay Area, but you go all the way up from 62 in Napa Valley down to 11 in Santa Clara County, and how one number of 25 reflects that is beyond me. And with that, we've concluded the presentation. I'm not seeing any unmuted mics. And again, these are the chapters you can jump to. They're all in the time stamps in the description below on YouTube. Thanks. Have a great week. Take care. Bye for now.